Hey there, Tristan from Purpose Advisory. Just want to do a quick recap on our last event. We did a Thursday evening event. So normally we do these events throughout the middle of the day, 12 o'clock, 12:30. But I'm based in Germany at the moment, and so I ran a 7 p.m. Sydney time session and got a really positive feedback. So for those of you who are keen on doing the evening sessions, please let us know. Send a comment here or send us a message saying, yes, I love more evening sessions. We're happy to diversify it up and make sure these sessions are available for you. I want to give a couple of the highlights and key thoughts, what we discussed in the session. It was all about how to invest in a recession, and we are currently in recession. I mean, this global chart, this is a pretty good tool by Market Insider, markets.businessinsider.com/indices, and it'll just give you the last 24 hours. If you're an investor, you're probably very fixated on what's just happened because that's all the new information. In theory, you know everything that's happened before. Most of us don't really know what's been happening before. So these one-day trading sites where they only give you the last 24 hours don't make as much meaningful sense, but it can give you an overall picture of what the globe's looking like. The whole world, but Italy at the moment, is going backwards. It'll tell you what the strongest gainers were. So the US dollar has been going up quite consistently. I might even just look at the US dollar chart, and that will give us an indication of what's been happening with it. Now, why does that matter? US dollar is one of the most important things to follow. This is the relative strength of the US dollar to all the other major currencies. So it's a bit of like a one versus the rest type chart. And as you can see, over the past year, it's just been pumping up. Now, if the dollar is worth more, it's because more people want the dollar. People are buying the dollar. In other words, they're selling out of assets and buying dollars. Why do US dollars matter so much? Because they are the central cash reserve of the planet. The US dollar for the last 50 years has been effectively the gold of the 50 years before that. It's the place you go when you're freaking out. So US dollar growing consistently, and it's been spiking. You're not supposed to see the dollar spiking so clearly as this, but this is showing that there's a lot of fear in the markets, and you can see that this is a complete inverse relation to what the US stock market has been doing, even to what gold has been doing largely in that time. The dollar going up should mean that gold sort of goes down, because like I said, gold and the dollar kind of fight for the place of being the safe haven. And if the dollar is the safe haven for now, then people aren't loving gold so much. Gold is really just a safe haven when everything's falling apart. You can see that gold spiked just at the peak of the war when it was first introduced, and then ever since that spike, it's been pulling back. So what does that say? It says that things aren't absolutely atrocious. Things were feeling absolutely atrocious in February. We're freaking out. We didn't know what was going to happen. There's still fear, but people are mostly allocating their assets to gold. What else is gaining? The VIX. That's the global volatility index. In other words, how much are markets doing this rather than just a gradual this? How much range is there to movements? The higher the volatility, typically the more downside it's going to be. You don't tend to get high volatility ups, you tend to get high volatilities down. So a large volatility swing is indicative of a down period. If we look at what's happening in the VIX at the moment, look over the longer term, not just the almost 10% change in a day. That's pretty exceptional. I'll see if there's a chart that loads here. You can see that the VIX spikes around a lot, but we've had a lot of high periods. Again, that was during the war. There was a more recent, settling of the volatility index. That was as the market was gaining more gradually, but then ever since peak in mid-August, you've seen the VIX starting to pick up, and we're starting to get closer to these sort of panicky highs. So 100% is kind of as high as you can kind of expect it to be. We're sort of at that 70% range. So we're pretty close to the fear side at the moment. Maybe look at oil. We all know that from an affordability point of view, oil has been becoming very expensive this year, and you can see that over the course of this year, it's been really spiking. It spiked also during the war. It kind of reached a crescendo, and it's been pulling back since June. We're seeing relative weakness in oil. I wouldn't be surprised if there's a bit more downside as the dollar continues to pick up until there's a bit of a seesaw effect, and you're going to see, for example, there's so many reasons that would affect energy, but this winter, what do you got? You got Putin most likely turning off the taps to Germany, and there'll be no supply, and there won't be enough supply for oil around the world, and countries would try to turn on their own supplies, but it'll be too little too late. So you can only expect there'll be some upsides in oil. along with lots of the other commodities. At the moment, they're all kind of getting affected by this fear, this selling. But soon, I think you're going to see not just fear and selling, but you're going to see legitimate high demand, limited supply. And when demand is high, supply is low, you're always going to get price pushing up. It's just a matter of how much demand and how much supply. And so you get some quite clear trends. You could say that the trend of all the stock markets is down globally at the moment. It would be interesting to work out where the relative strength would be. I think the places to be focusing a bit more is maybe looking at Brazil, looking at India, looking at China. These are three major global players that have been unloved. If you look at their charts over the last 5-10 years, they've largely gone sideways, whilst the US and even Australia and Europe have done quite strongly, especially the US, so incredibly strongly, and it's now in its correction. So once this, I guess, global inflation epidemic has been somewhat curtailed and curbed, that's the major driving factor. Inflation's the big enemy. All the governments are trying to fight the inflation, and they're pulling back the economies as a result. There's a lot of fear in the environment, and so everything's selling off. But what you're going to see, I think, is some relative strength in these up-and-coming economies. These are not the sort of economies that most people invest in. There's more risk associated with them. A lot of people don't feel comfortable with them, but it represents some value. You could argue that all three of them in a really tough place. China's in a very tough place economically at the moment. Brazil's always been in a tough place. India's kind of up and coming, but they've all got headwinds. It's just more interesting to see what level of growth that they can expect over the next 5 to 10 years relative to, for example, China, relative to, for example, the US and Australia and Europe. So with all those thoughts, different directions of different assets, one of the things to bear in mind is there's always a good time for something. There's always a biggest gainer and there's always a biggest loser, every day and every month and every year. So the point is to get a sense of what it is that you're investing in the short term, and more importantly, what are you investing for the long term? What are the things that you see as strong for the next medium, long term? What are the goals? How do you frame yourself to invest for the long term? One of the most famous investors of all time, who we talked about in our discussion on Thursday, is Warren Buffett. He's famous for saying, best thing you can do any time of any year is regularly buy into an index that you believe is a solid enough, for example, a US index or maybe an Australian index, something that you know is going to do well over the long term, 10, 20, 30 years, and then make sure your holding period is forever. If you can afford to invest for forever, that's the easiest way to do it. In reality, we rarely invest for forever. A lot of us have a home maybe we're saving for, or we're going to retire soon, or perhaps we want to start a business, or we have an intention to do something with our money at some point in the future. So if you have funds that are less than forever type investments, 2 years, 5 years, 10 years, then now is a great time to get educated on all these charts I looked at. What do each of these indexes mean? What do these little 3-letter acronyms mean? What does 1 day versus 1 year performance mean? How can you get a sense of whether things are going up and going down? How do you interpret news and current affairs? How do you read a chart? You know, when you, these two are probably bad examples of charts to be reading, but the S&P 500, which is the top 500 stocks in the US, it's a great chart to learn how to practice technical analysis. What do these volume bars mean down the bottom? You can look at moving averages or even momentum. If I put on moving average, you can see how the price that sometimes has been above its average and other times has been below its average. What does it mean when it's above? What does it mean when it's below? There's so many ways that you can analyze the data, and all of it does help in your decision of what to invest in and when to invest. And one of the main things I would encourage any investor in this market is to take time, stop and educate. If you're heavily invested right now, especially if you're invested in equities, the question you have to answer is how much downside do you think there will be if we go to, let's say, the 5 years, and I'll be able to pin ourselves at the same price that we were early 2021. So we've probably gone nowhere in the last 18 months, up and down. But is that the end of our drawback, or could we be dropping as far as the pre-COVID lows or even the COVID bottom? Now, I wouldn't be surprised for us to see the pre-COVID highs, and my base case is actually that we could get as far as down here. And you then have to make a decision. If we are to head down that far, what does that mean for you? Do you hold through it and keep buying all the way through? If you're young, you're earning income, and you've got the ability to save longer term, that makes a justifiable reason. There's a justifiable reason to do that, I should say. If, however, you're looking to retire in the next 12 months and you need to sell down your whole portfolio at some stage and live off it, or even just part of your portfolio, or maybe you're saving for a house, then it's a much higher risk to wait out the market and see if you can take some downside. Now, we never want to put pressure on ourselves to have to sell and then buy back. That's hard to do because you have to time the exit and time the entry. If you get either one of those two wrong, you might buy in for higher than you sold out, you might make a loss. Or you might wait out of the market for too long and you just miss the opportunity. Both of those situations happen a lot when people aren't planned and educated and confident enough. But if you have a strong amount of assets, 100, 200, 300,000 of assets, or maybe you're a superannuation and you're looking to use it soon, then now is definitely a time to think, have I divested enough? Since the highs at the end of last year, have I taken some money off the table? Have I taken some profits? Have I been smart in my risk allocation, or am I still too risk heavy? Because there's a lot of negative sentiment, a lot of fear out there, and if you look at most indications, everyone's thinking it's going to keep going down, at least in the short term. And whether that continues for a week or 3 months, it's going to affect your wealth level. So investing in a recession looks and feels very different depending on if you've got a long time frame or a short time frame. It also feels very different based off if you're educated or not. This is a great time for anyone who's educated and confident, because you will know that great prices are coming. You just have to stay avid with your eye on the ball. If you don't know what's happening, this is a time of fear and uncertainty and doubt, and you'll never know what is right, and you'll either completely play the avoidance game or you'll just stress and fret, and neither of those is advisable. If you want to learn more about how to trade, how to invest, how to understand how markets work, and to get more engaged in your investing, we'd love to help you out. We run these events all the time. I'll accept cookies, thank you very much. These are upcoming events we've got. You're very welcome to come along to any of our free events. We run them every fortnight. The next one being on the 6th of October. I'm going to be doing an event called Starting Business, What You Need to Know. That will also be an evening event, 8 p.m. Sydney time. And then 2 weeks after that, in October, how to manage your stress levels and avoid burning out. That's with Harry. If you'd like to go deeper dive and really learn alongside other investors, then we'd like to open up an opportunity for you to be part of our share investment mastermind. We run these over 4-week sessions, 1.5 hours per gathering. We tend to do it during the day, but sometimes in the afternoon or evening. It's going to be based off whoever expresses an interest, that we'll find a time that suits you all. We'll be covering a range of different content areas, everything from understanding the macroeconomy, understanding fundamental analysis, how to assess a stock, to know the nuts and bolts of it, the accounting side of things, also to do the technical analysis, and importantly the practicals, how to set up a trading account, how to set limit order, how to buy, how to make great decisions. And throughout the whole thing, we'll be talking about the psychology of our decisions, and obviously practicing, learning from each other's experiences and making sure we're all making better decisions. If that's the sort of thing that you want to learn, whether that be for stocks, for crypto, for gold, anything in between, we'd love to equip you with the skills that we have. So please come along to this expression of interest page. You can submit your details and just submit down the bottom. We'll make sure this link is included in the description below. We run these on a regular basis. This is a more apt time than ever before, but if you're watching this video and it happens to be months after we've recorded it, please express interest. We'll likely have another one that's running ready for you. So we look forward to the chance to meet you or to have you come along to one of our events sometime soon.